Hi, folks. This is Mike Zlotnik, Big Mike, and today's discussion is going to be all about the concept called infinite return, and just going to explain it as simple as I can. It's a marketing term. It's a marketing ploy. It's not a real thing in my view, because I'm a mathematician, and the infinite return doesn't exist in a manner of speaking. So folks have used this concept, and we'll break it down in just a second. But before we do that, disclaimer, this is for informational, educational purposes only, no solicitation of any kind, no advice of any kind. Before making any investment decisions, consult with your attorney, CPA professional. So again, infinite return concept, how does it work? Let me break it down as simple as it works. Typically, it is used in real estate, quite often by syndicators. They claim, hey, the deal is going to have an infinite rate of return. What does it mean? It means that they're going to buy a property, execute value add strategy, then do a refi. And as part of the refi, they project that they will return investors' preferred return, 8% preferred return or 10%, whatever the number is, and a return of capital. And what's going to be left in the deal is investors are going to keep permanent equity in the deal, whatever the percentage they had originally as part of the offering. So the deal could have 8% preferred return and then a 70-30 split after 8, right? So in the execution of the infinite return concept, it's just basically a refi event that returns their principal back together with a preferred return. Let's use an example, just so you can understand how mathematically would work. And in the waterfall example that I just gave, 70-30 split over 8. So the way it would work, investors raise all the capital. Let's use a very, very simple deal, okay? So it's a commercial multifamily asset, $10 million equity, $20 million debt, about 2/3 leverage. And of the $10 million equity, somebody participates for $100,000 piece in that $10 million raise. And the preferred return is 8%, and the deal takes 3 years to get to a refi point. So let's fast forward. 3 years after the deal started, the deal is now, the value has increased substantially through the execution of the value add strategy, and now it's ready for the refi. At the refi event, the deal is so successful that it gets back all the principal plus 8% for 3 years, which is 24%. So $100,000 investors would get back 24% of preferred return for preferred income, the $100,000 back, and they're still staying in the deal for 70% as a pool of investors. So $100,000 owns 1% of $10 million capital raised. So, but that equity that's left in the deal has actually quantifiable value. And for the sake of simplicity, if the deal were to sell instead of refinance, that money would come back in cash. So investors would receive not only 8% pref, but they would receive a value for the sale of the equity. And if the sale of the equity was worth another 10% a year, so investors would receive 8% in pref and another 10% in the upside on the deal if it were to sell, but it's not selling. So they're left with 10% times 3 years, which is 30%, on $100,000 is $30,000. So investors invested $100,000, received, again, as an example, one investor, they received $100,000 principal back, received $24,000 of preferred return, 8% times 3 years, and then they're left in the deal with $30,000 of approximate value of the equity. So what is the return on this deal? Well, for the phase one of the deal, which is from acquisition till refi, investors effectively generated 8% of pref, and then they also generated 10% of additional equity growth per year in the form of equity that's left in the deal that's staying beyond the refi point. So the rate of return is 18%, not infinite. So what happens after the refi point? Well, after the refi point, they're left with $30,000 worth of theoretical equity in the deal that's going to stay for a long time, or however long the deal it takes until its sale event or maybe the next refi event. The concept is that $30,000 now starts generating fresh rate of return. So for phase one, investors received 18% annual return for 3 years. 8% they got in the form of cash or the time of the refi plus the principal back, and then the 10% was left to live in the deal for the future. So phase one, 18% annual return. Now phase two, the annual return could be 12% a year, could be something higher or lower. It depends on how the market does. It depends on many circumstances. But that phase of the project typically means the property has been stabilized, refinanced. It is going to generate a return on sale. Let's just say in another 5 years. For sake of simplicity, let's just say in another 5 years, the property generated a sale event such that it generates another 10% a year, and it generated another 2% per year in distributions. So the phase two return can actually be computed. In the example I just gave, it becomes another 10% a year in growth, another 2% a year in cash flow, right? So all of this can be quantified in mathematical terms. So I hope it makes sense. The infinite return is a marketing term. That's all it is, because returns are not infinite. If the project is very successful, so let me give you another example where the project generates, for the first phase of the project, they catch a great timing and the project is very successful, and investors get their 8 pref back, they get their principal back, and the property value increased so much that that component that's left in the deal could be worth not 10%, but it's worth 20% a year. The value increased a lot. So their return for the first phase of the project is 8% they received, plus another 20% in equity that is left in the deal for the future. So what is the annual return? It's 28% a year. The point that I'm making, it is finite. You can actually compute it, and it's not difficult to do because you know the valuation at a time of the refi, you know what you received in cash, and you know what's left in the deal for the future. And then when the deal exits, you know what you're going to get in the future. And in the example that I gave, again, in the 8% pref that you receive plus return of capital, and 10% is left in the deal. The 10% could double in 5 years. Then its effective forward rate of return on the remaining money becomes 20% a year, right? It's all very easily computable. Phase one return 18%, phase two return 20% a year. That's as simple as that. Not very difficult math. So it's not really infinite, it's finite. And it depends on how the deal performs. Sometimes phase two outperforms, sometimes phase one outperforms. Generally speaking, on a value add deal, phase one, if things go well, should generate higher rate of return than the phase two. Because phase two means the property has been stabilized, it's harder to increase the value. So it can still generate rate of return, just not as high as the phase one. So it's never infinite. There's always a finite, at least estimate with finite projection. The actual results may drastically differ from projections. Nonetheless, you can mathematically compute what it is. So I appreciate your time and attention. Hope it makes sense. Until the next time. Thank you.